spreads are preferred by professional traders over selling of naked options to collect theta. I wanted to show you just one more thing here. That is true for both the upside and the downside on this position. The most we can lose on the downside is $110. And it doesn't matter how low the stock goes. What happens if the stock all of a sudden collapses completely? You would still lose only a maximum of $110. That's why we prefer spreads to the purchase or sale of individual options. Now, even so, even though we have limited upside potential, we have extremely limited downside potential because our maximum loss on this position is only $110. But look at our break-evens. We have break-evens at 71 and we have break-evens at 79. We have a tremendously wide break-even on this position. In fact, we cannot lose on both sides of this position. We can only lose on one side. The other side will actually make a profit. Let's do this just as a kind of as a learning lesson here. We have a fairly wide range in which the stock can move, and we can achieve our maximum profit if the stock moves within this range at expiration. Remember that this green line represents the maximum profit we can achieve at the expiration date. This white line is the amount of profit or loss that we can achieve at this particular moment in time. So as of today, if we put this spread on, yes, we'd have an immediate loss of $3.83 on one contract. Remember, we're always on credit spreads, we're always going to have a loss immediately when we put it on, and that basically represents the marker's spread and their actual profit when they sold it to us. So, and it also includes, like, the spread between the bid and the ask, which theoretically the market makers actually make money on. I'm not saying they actually do, because sometimes they don't, but that is their theoretical profit. What happens when we take one of these side spreads off? If you go down here to the Analyze tab under the Positions and Simulated Trades, if we just unchecked one of these boxes, what it'll do is it'll take that position off of our profit picture here. So let's take that off. And you can see that now if we only have the one vertical spread on there, if the stock stayed the same or went up, we would receive the maximum credit. If it goes against us and goes down, then we will achieve the maximum loss. The maximum loss in this case is $325. The maximum gain is $175 because we sold this spread for a $1.75 credit. You can do that. If you have a strong belief about the future potential of the stock, you can in fact do just one side of the vertical spread. However, in most cases, and I know this is, this includes myself, I'm not very good at predicting price. Although I do have some unique tools and experience doing technical analysis, many times you just don't know. I mean, you think something is going up, it doesn't, or it just stays the same and it just wears away at your position. That's why we tend to do double spreads. In this case, a double vertical spread. This is very similar to an iron condor. Very similar. This is actually the sale of a straddle with protection. Now the protection of it is the call that we bought at a slightly higher strike price, and the put that we purchased at a slightly lower strike price. So you can see exactly what this looks like. Now let's take a look at what an iron condor would look like. We've already talked about how we do vertical spreads to collect a premium. Normally an iron condor is the sale of a vertical spread on the call side and the sale of a vertical spread on the put side. So you've got a sale of a vertical spread, and I'm just going to change this to the 80s and the 85s. So it's the sale of two out of the money vertical spreads. That's all an iron condor is. Now if we analyze these trades together, we can see that we have a slightly different profit picture than the one we had before. Instead of a very tall peak in the center of our profit picture, we actually have a long horizontal line here that indicates our potential profit in this position. Our break-evens are extended to 68 and to 82. It's a bit wider of a profit range in which we can move. And the majority of professional traders like this better than the sale of a straddle with wings as protection, because they do have this very wide profit potential picture. In the case of the sale of the straddle, I think our break even on the low point was around 71 and around 80 on the high end. This gives us a little bit wider profit potential and break even points at 82 and about 67 or 68. So a lot of people, a lot of professionals would prefer this as a potential trade. That is an iron condor. That's all it is. An iron condor is the sale of a out-of-the-money vertical call spread and the sale of an out-of-the-money put spread. And that's all it is. So now that you've seen what a iron condor is, let's take a look at a calendar. And you're probably thinking, well, if we're doing iron condors, and let's say we do one on the SPY, which is the SPDRs, the S&P 500 ETF. Let's set up, I did an individual. You can also enter these orders, rather than as individual sale of vertical spreads, you could also enter these as a single order, and you can go ahead and sell iron condor. It's right here. Now, you don't want to buy an iron condor. The purchase of an iron condor is an out-of-the-money bullish call spread and a bearish put spread, and I'll show you the difference here. Sometimes it makes sense to buy an iron condor, which are out-of-the-money vertical spreads. Let's take a look at the profit picture for this. Well, I got to change these strike prices first. In the Thinkorswim platform, the option that you want to put on your spreads at, when you right-click, automatically defaults to that particular strike price, but on the call side. But on the put side, you have to change it. So let's say we want to go down to the 133, 132. And 132. Okay, now let's analyze this for a second. Oops, I have a number of different positions on here, so I got to hide my positions. Here we go. With the sale, or I'm sorry, with the purchase of an iron condor, so you can both purchase an iron condor and you can sell an iron condor. With the purchase of an iron condor, the graph is completely opposite of the sale of an iron condor, because at expiration, if the price were to remain stable, you would achieve your maximum loss if the price did not move. If the price moved dramatically, then you would achieve your maximum profit. So the only reason that you would want to buy an iron condor is if you think there's going to be dramatic price movement in the underlying stock, ETF, or future, or whatever it is that you're buying. If the price moves within a very, very narrow range, you will have achieved your maximum loss. Also notice that theta is negative on the purchase of an iron condor, and delta is positive. That's because you're buying a call option and you're selling one at a lower price. So your delta is going to be positive.